There is a version of the individual retirement account that your brokerage firm has never mentioned, that your 401k plan administrator has never described, and that the mutual fund industry spends significant resources making sure you never think to request. It allows you to take the same retirement savings that are currently invested in stocks and bonds chosen by a fund manager at a large financial institution and redirect those savings into real estate, gold, silver, private business equity, cryptocurrency, tax liens, mortgage notes, and dozens of other asset classes that a standard IRA explicitly prohibits. The tax advantages are identical to a traditional or Roth IRA. The contribution limits are the same. The required minimum distribution rules are the same. The only thing that changes is what you are allowed to buy. And the answer, in a properly structured self-directed IRA, is almost anything that the IRS has not specifically prohibited. The IRS has a short list of prohibited investments for all IRAs. Life insurance contracts, most collectibles including artwork, wine, gems, and some coins, your primary residence or a vacation home that you personally use, property you personally benefit from before retirement. This list is short. Everything else, the entire universe of investment assets that is not on this list, is technically permissible in an IRA under Section 408 of the Internal Revenue Code. What your broker never told you is that a standard brokerage IRA is not actually limited by the tax code. It is limited by the brokerage firm's own product menu. Fidelity will not let you buy a rental property in your IRA because Fidelity does not earn commissions or management fees on rental properties. Vanguard will not let you invest your IRA in a small business because Vanguard's revenue model is built on mutual fund expense ratios, not private equity. The limitation is not legal, it is commercial. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. The Self-Directed IRA traces its legal foundation to the Employee Retirement Income Security Act of 1974, known as ERISA, which established the modern framework for retirement accounts. Section 408 of the Internal Revenue Code, enacted as part of ERISA, created the individual retirement account and defined what kinds of assets could and could not be held in it. The statute itself is broad. It does not restrict IRAs to stocks, bonds, or mutual funds. It simply defines the tax treatment and establishes the prohibited transaction rules. The reason most Americans believe IRAs can only hold conventional securities is not the law. It is the fact that the major financial institutions that administer IRAs have never built the infrastructure to hold and administer non-conventional assets. A custodian that holds a rental property must manage property management coordination, title documentation, insurance verification, and rental income collection. It is far more operationally complex than holding a mutual fund. So brokerage firms chose the simpler menu and marketed it as if it were the complete menu. The self-directed IRA is structured identically to a conventional IRA for tax purposes. A traditional self-directed IRA takes pre-tax contributions and grows tax-deferred. Distributions in retirement are taxed as ordinary income. A Roth Self-Directed IRA takes post-tax contributions and grows completely tax-free. Qualified distributions in retirement are tax-free. The annual contribution limits for 2024 are $7,000 for individuals under 50 and $8,000 for individuals 50 and older, identical to conventional IRAs. The real estate investment capability of a self-directed IRA is not about contributing more money. It is about using what is already accumulated in a retirement account to access a broader range of investments. The vehicle that makes real estate investment in a self-directed IRA possible is the self-directed IRA with checkbook control, sometimes called an IRA LLC. The structure works as follows. You establish a self-directed IRA with a specialized custodian. Unlike Fidelity or Vanguard, these custodians are specifically set up to hold non-conventional assets. Examples include Equity Trust Company, Pensco Trust, Midland IRA, Kingdom Trust, and Alto IRA. The IRA then makes an investment into an LLC that you establish and manage. The LLC opens a dedicated bank account. You, as the manager of the LLC, have checkbook authority over that account. When you identify an investment opportunity, you write a check or initiate a wire from the LLC's bank account, and the LLC makes the investment on behalf of the IRA. This checkbook control structure eliminates the delay in transaction fees that would otherwise occur if every investment decision required the custodian's approval and processing. Before I go further, this video is just the surface. Inside the Invisible Ledger Vault, you will find the complete self-directed IRA custodian comparison guide, the IRA LLC formation checklist, the prohibited transaction rules with specific examples, the real estate acquisition step-by-step guide within an IRA structure, and the solo 401k comparison for self-employed individuals who may benefit from an even more powerful alternative. The link is in the description, but stay right here. The prohibited transaction rules are the critical regulatory boundary in self-directed IRA investing. and they are where investors most frequently create catastrophic problems by acting without sufficient understanding. Section 4975 of the Internal Revenue Code defines prohibited transactions as certain transactions between an IRA and a disqualified person. Disqualified persons include you, your spouse, your linear ancestors and descendants, including parents and children, your siblings, the IRA's fiduciaries, and certain business entities in which any of the above have significant ownership interests. A prohibited transaction causes the entire IRA to be treated as distributed as of January 1st of the year in which the transaction occurred, triggering immediate taxation and potentially early withdrawal penalties on the entire account balance, not just the transaction amount. The most common prohibited transaction mistakes in self-directed IRAs include personally using IRA-owned property, even for a single night, having the IRA purchase property from yourself, selling property you own to the IRA, having your IRA invest in a business owned by a disqualified person, providing personal services to IRA-owned property, such as doing your own repairs on a rental, and having disqualified persons receive compensation from IRA investments. The rules are strict, and the consequences of a violation are severe. In one notable case, a taxpayer converted an IRA to a self-directed structure, used it to purchase rental property, and then personally managed the property, including making repairs. The IRS classified the management and repair activities as prohibited transactions, disqualified the entire IRA, and assessed tax and penalties on the full account value. An entire retirement account lost in a single compliance error. If you have made it this far, you already understand the self-directed IRA at a level that will prevent the compliance error that destroys most first-time users. Subscribe and share this video. Now let me give you the practical steps for using a self-directed IRA to invest in real estate. Step 1. Choose a qualified self-directed IRA custodian. Look for custodians with experience in real estate investments, transparent fee structures, and responsive customer service. The self-directed IRA industry has had instances of fraudulent custodians and Ponzi scheme operators. Verify your custodian's registration with the IRS and their reputation through independent reviews. Step 2. Open a self-directed IRA at your chosen custodian and fund it through contributions, transfers from existing IRAs, or rollovers from previous employer plans. A rollover from a 401k to a self-directed IRA is not a taxable event if completed within 60 days. Step 3. If you want checkbook control, establish an IRA LLC. Your custodian can guide you through this process. The LLC is owned by the IRA, not by you personally. Step 4. Identify a real estate investment that meets your criteria. The property must be purchased entirely with IRA funds, or with a combination of IRA funds and non-recourse financing. A non-recourse loan is one where the lender's only remedy in default is to take the property itself. The lender cannot pursue you personally. Regular mortgages with personal guarantees constitute prohibited transactions in a self-directed IRA. Step 5. All income from the property, including rent, must flow back into the IRA. All expenses, including property taxes, insurance, maintenance, and property management fees, must be paid from the IRA. No personal funds can be mixed with IRA funds in any aspect of the property's operation. Step 6. When the property is sold, the proceeds return to the IRA and grow according to the IRA's tax treatment, tax deferred in a traditional IRA, or tax-free in a Roth IRA. The tax-free compounding benefit in a Roth Self-Directed IRA is particularly powerful for real estate. A property purchased by a Roth IRA for $200,000 that appreciates to $500,000 over 10 years generates $300,000 of tax-free gain. Rental income collected over those 10 years is tax-free as it flows back into the Roth IRA. When the property is eventually sold and the Roth IRA account is distributed in retirement, every dollar comes out with no federal income tax. The real estate's appreciation and income stream have been permanently sheltered. I need to be honest with you. The self-directed IRA is powerful, but carries risks that a conventional IRA does not. First, the custodian landscape includes some operators who have been associated with fraud and Ponzi schemes. Due diligence on your custodian is not optional. Second, the prohibited transaction rules are complex, and the penalty for a single violation can be the destruction of the entire IRA. You need either extensive personal knowledge of the rules or qualified legal guidance before making every investment decision. Third, real estate within an IRA is illiquid. Required minimum distributions beginning at age 73 must be satisfied from the IRA. If the IRA holds only real estate, satisfying an RMD may require selling a property, which may not align with market timing. Fourth, non-recourse financing is more expensive and less available than conventional mortgage financing, limiting the leverage available for IRA real estate purchases. And fifth, UDFI, unrelated debt financed income, is a tax that applies to income and gains from IRA investments that are financed with debt. Even within a tax-advantaged IRA, leveraged real estate can generate a taxable event through UDFI. This significantly complicates the economics of using borrowed money in a self-directed IRA. Your grandparents invested in what they could see. They bought the land next to theirs. They invested in the business of a neighbor they trusted. They put their savings into things they understood and could touch. Then one generation was handed a 401k and told that a fund manager they had never met, investing in companies they had never visited, was the only appropriate destination for their retirement savings. The asset menus shrank to whatever the financial institution found profitable to offer. The self-directed IRA does not give you back everything your grandparents had, but it gives you back the choice. And the choice, used wisely, is worth decades of compound growth in assets that no brokerage firm will ever put in front of you. Subscribe and share this video. Every share expands someone's retirement investment universe beyond the menu a financial institution decided to offer. The next vault opens soon, and what is inside will pull back another layer of a financial architecture that was built in plain sight and counted on you never to examine closely enough to understand.